Hello, and welcome to the Investing Iguana, the YouTube channel that helps you grow your wealth with smart and savvy investing tips. I'm Iggy, your friendly and fun-loving host, and today we're going to talk about value investing in Singapore. Value investing is one of the most popular and proven investment strategies in the world, and it has been used by legendary investors like Warren Buffett, Benjamin Graham, and Peter Lynch. But what exactly is value investing, and how can you apply it to the Singapore stock market? That's what we're going to find out in this video. In this video, you will learn A. What is value investing and how does it work? B. What are the key characteristics of a value investor? C. How to find undervalued stocks in Singapore using various methods and tools. D. How to avoid common pitfalls and mistakes when practicing value investing. And E. How to build a diversified and profitable value investing portfolio. By the end of this video, you will have a solid understanding of value investing and how you can use it to achieve your financial goals. So buckle up, grab a snack, and get ready for an exciting journey into the world of value investing. Before we begin, I want to remind you to hit the like button if you enjoyed this video, and subscribe to my channel if you want more awesome content like this. Also, feel free to leave a comment below and share your thoughts or questions about value investing. I love hearing from you, and I'll do my best to answer them. Alright, let's get started. What is value investing? Value investing is an investment strategy that focuses on identifying undervalued stocks in the market. It involves analyzing the true value of a stock, considering factors such as the company's financials, business prospects, and market conditions. The goal of a value investor is to invest in stocks that are trading below their intrinsic value, with the expectation that their price will eventually reflect their true worth. Understanding the concept of value investing. At its core, value investing is about buying assets for less than they are worth. It's like finding a great bargain at a sale. You get a high-quality item for a fraction of its original price. Similarly, value investors seek out stocks that are trading at a discount compared to their intrinsic value. By doing so, they aim to achieve long-term capital appreciation and create wealth over time. But how do you determine the intrinsic value of a stock? And how do you know if a stock is undervalued or not? Well, that's where the art and science of value investing comes in. Value investors use various methods and tools to analyze stocks and estimate their true value. Some of these methods include A. Discounted cash flow analysis. This method calculates the present value of the future cash flows that a company can generate over its lifetime. It assumes that a stock is worth the sum of its future cash flows discounted by an appropriate interest rate. B. Earnings power value. This method estimates the value of a company based on its current earnings and its ability to sustain or grow them over time. It assumes that a stock is worth the present value of its future earnings. C. Asset-based valuation. This method values a company based on its net assets or book value. It assumes that a stock is worth the difference between its total assets and total liabilities. D. Relative valuation. This method compares a company's valuation metrics, such as price-to-earnings ratio or price-to-book ratio, with those of similar companies or industry averages. It assumes that a stock is undervalued if it has lower valuation ratios than its peers or benchmarks. These methods are not mutually exclusive, and value investors often use a combination of them to arrive at a range of intrinsic values for a stock. The more conservative the assumptions and estimates used in these methods, the more reliable the intrinsic values will be. Key characteristics of a value investor. A value investor possesses certain key characteristics that set them apart from other investors. They have a patient and disciplined approach to investing, focusing on the long term rather than short-term gains. They conduct thorough research and analysis of potential investment opportunities, looking for companies with strong fundamentals and sustainable competitive advantages. Value investors also have a margin of safety mindset, which means they only invest when there is a significant gap between a stock's market price and its intrinsic value. Let's take a closer look at each of these characteristics. Patience. Value investors understand that it may take time for the market to recognize the true value of a stock. They are willing to wait for years until their investment thesis plays out. They also avoid chasing hot trends or fads that may not last long or may be overpriced. Discipline. Value investors stick to their investment criteria and strategy, regardless of market fluctuations or emotions. They do not let fear or greed influence their decisions. They also review their investments periodically and adjust them if necessary. Research. Value investors do their homework before investing in any stock. They study the company's financial statements, annual reports, industry trends, competitive landscape, and growth prospects. They also look for any red flags or risks that may affect the company's performance or valuation. Fundamentals. Value investors focus on the quality and value of the business, not the price of the stock. They look for companies that have strong balance sheets, consistent profitability, stable cash flows, and competitive moats. They also avoid companies that have excessive debt, declining earnings, or poor management. Margin of safety. Value investors seek a margin of safety when investing in a stock. This means they buy a stock only when its market price is significantly lower than its intrinsic value. This provides a cushion against any errors in valuation or unforeseen events that may affect the stock price. The larger the margin of safety, the lower the risk and the higher the potential return. Watchlists. Watchlists are lists of stocks that you monitor regularly for potential investment opportunities. You can create your own watchlists based on your research or follow the watchlists of other investors or experts. For example, you can follow the watchlists of famous value investors like Warren Buffett or Seth Klarman, or local value investors like Dr. Wealth or The Fifth Person. You can also use watchlists to track the performance of your existing investments and decide when to buy or sell them. Newsletters. Newsletters are publications that provide insights, analysis, recommendations, and tips on various stocks or investment topics. You can subscribe to newsletters that focus on value investing or Singapore stocks to get ideas and guidance on finding undervalued stocks. Some of the popular newsletters for Singapore value investors include The Smart Investor, Value Invest Asia, and The Motley Fool Singapore. Blogs. Blogs are websites that offer personal opinions, experiences, stories, and advice on various stocks or investment topics. You can follow blogs that cover value investing or Singapore stocks to learn from other investors' perspectives and strategies. Some of the popular blogs for Singapore value investors include Investment Moats, A Path to Forever Financial Freedom, and Turtle Investor. These are some of the ways you can find undervalued stocks in Singapore. Of course, you should not rely on any single source or method blindly. You should always do your own due diligence and analysis before investing in any stock. How to avoid common pitfalls and mistakes when practicing value investing. Value investing may sound simple and straightforward, but it is not easy to execute. There are many pitfalls and mistakes that can derail your value investing journey and cause you to lose money or miss out on opportunities. Here are some of the common ones and how to avoid them. Confusing cheap with value. Not every stock that has a low price or a low valuation ratio is a good value investment. Sometimes, a stock is cheap for a good reason. It may be facing serious challenges or risks that could impair its future prospects or viability. For example, a company may have declining sales, shrinking margins, rising debt, legal troubles, regulatory issues, or technological disruption. These factors could erode its intrinsic value and make it a poor investment choice. To avoid this pitfall, you should look beyond the price or valuation ratios and examine the quality and fundamentals of the business. Falling into value traps. A value trap is a stock that appears to be undervalued but never recovers its true value. It may be stuck in a declining industry, losing market share to competitors, suffering from poor management decisions, or facing structural problems that cannot be easily resolved. A value trap can lure unsuspecting investors with its attractive valuation metrics or dividends, but end up disappointing them with poor performance or losses. To avoid this pitfall, you should look for signs of improvement or catalysts that could unlock the true value of the stock. You should also have an exit strategy in case the stock does not meet your expectations. Overpaying for a stock. Another common mistake that value investors make is overpaying for a stock, even if it is a good company. Sometimes, a stock may have a high intrinsic value, but its market price may be even higher, reflecting unrealistic expectations or excessive optimism. For example, a company may have strong growth potential, loyal customers, or innovative products, but its stock price may already factor in these advantages and more. Buying such a stock may result in low returns or losses if the market sentiment changes or the company fails to meet the expectations. To avoid this pitfall, you should always compare the market price and the intrinsic value of a stock and look for a margin of safety before investing. Ignoring the macro environment. Another common mistake that value investors make is ignoring the macro environment or the big picture. Sometimes, a stock may be undervalued due to external factors that are beyond the control of the company or the industry. For example, a stock may be affected by global events, economic cycles, political developments, social trends, or environmental issues. These factors could have a significant impact on the demand and supply of the products or services that the company offers, as well as its costs and revenues. Ignoring these factors could lead to poor investment decisions or missed opportunities. To avoid this pitfall, you should always keep an eye on the macro environment and how it affects your investments. Being too rigid or dogmatic. Another common mistake that value investors make is being too rigid or dogmatic in their approach. Sometimes, a stock may not fit into the conventional criteria or definitions of value investing, but it may still offer a great investment opportunity. For example, a stock may have a high valuation ratio, but it may also have a high growth rate, a strong competitive edge, or a loyal customer base. Such a stock may not be considered as a value investment by some investors, but it may still be undervalued relative to its future potential. Being too rigid or dogmatic in your approach could cause you to miss out on such opportunities. To avoid this pitfall, you should always be flexible and open-minded in your approach and consider different perspectives and scenarios. These are some of the common pitfalls and mistakes that value investors face and how to avoid them. By being aware of them and learning from them, you can improve your value investing skills and results. How to build a diversified and profitable value investing portfolio. Finally, let's talk about how to build a diversified and profitable value investing portfolio. A portfolio is a collection of stocks that you own and manage according to your investment objectives and risk tolerance. A diversified portfolio is one that consists of stocks from different sectors, industries, markets, geographies, and styles. A profitable portfolio is one that generates positive returns over time and beats the market average. Building a diversified and profitable value investing portfolio is not an easy task. It requires careful planning, execution, monitoring, and evaluation. Here are some steps that you can follow to build your own value investing portfolio. A. Define your investment goals. The first step is to define your investment goals and what you want to achieve with your portfolio. Your goals could be related to your income needs, capital appreciation potential, retirement plans, or any other financial objectives. Your goals will help you determine your investment horizon, how long you plan to invest, your risk appetite, how much risk you are willing to take, and your expected returns, how much return you are aiming for. B. Choose your investment strategy. The next step is to choose your investment strategy and how you want to implement it. Your strategy could be based on your preferred method of finding undervalued stocks, such as discounted cash flow analysis or relative valuation, your preferred criteria for selecting stocks, such as low price-to-earnings ratio or high dividend yield, or your preferred style of investing, such as growth-oriented or income-oriented. Your strategy will help you narrow down your universe of potential stocks and focus on those that match your preferences. C. Select your stocks. The next step is to select your stocks and build your portfolio. You can use various sources and tools, such as screeners, watch lists, newsletters, or blogs, to find undervalued stocks that fit your strategy. You can also use various metrics and indicators, such as earnings growth rate, return on equity, debt-to-equity ratio, or free cash flow, to evaluate the quality and performance of the stocks. You should aim to select stocks that have strong fundamentals, sustainable competitive advantages, attractive valuation ratios, and positive growth prospects. D. Allocate your capital. The next step is to allocate your capital and decide how much money you want to invest in each stock. You can use various methods, such as equal weighting or risk weighting, to allocate your capital according to your risk-reward profile. You should aim to allocate your capital in such a way that maximizes your expected returns while minimizing your risk exposure. D. Diversify your portfolio. The next step is to diversify your portfolio and reduce your concentration risk. You can diversify your portfolio by investing in stocks from different sectors, industries, markets, geographies, and styles. You should aim to diversify your portfolio in such a way that reduces your correlation with the market and enhances your performance in different scenarios. F. Monitor and rebalance your portfolio. The final step is to monitor and rebalance your portfolio and keep it aligned with your goals and strategy. You can monitor your portfolio by tracking its performance, reviewing its holdings, and analyzing its risk-return profile. You can rebalance your portfolio by adding or removing stocks, adjusting your capital allocation, or changing your diversification parameters. You should aim to monitor and rebalance your portfolio periodically, such as quarterly or annually, or when there are significant changes in the market or your circumstances. These are some of the steps that you can follow to build a diversified and profitable value investing portfolio. By following these steps, you can create a portfolio that suits your needs and preferences and helps you achieve your financial goals. That's it for this video. I hope you enjoyed it and learned something new about value investing in Singapore. Value investing is a powerful and rewarding investment strategy that can help you grow your wealth over time. By understanding the concept of value investing, developing the key characteristics of a value investor, finding undervalued stocks in Singapore, avoiding common pitfalls and mistakes, and building a diversified and profitable value investing portfolio, you can become a successful value investor in Singapore. Thank you for watching this video. If you liked it, please hit the like button and share it with your friends. If you want more awesome content like this, please subscribe to my channel and hit the bell icon to get notified of my new videos. And if you have any questions or comments about value investing in Singapore, please leave them below and I'll try to answer them. This is Iggy from the Investing Iguana, signing off. See you next time.